Applying for a home loan can be a confusing and worrying time for some people, but it doesn't have to be that way when you have the right advice. Here's finance guru Caroline Pollard with the latest Bayside Finance Solutions podcast.
Hello, and thanks for joining me. Today, I'm going to explain exactly what lenders look for when assessing your ability to repay a loan. Lenders will assess your worth based on the 5 C's of credit. So that's character, capital, capacity, collateral, and conditions. So I'll briefly explain what each one of those mean. Number 1 is character. Now this relates to your willingness to pay back the mortgage. The lender will check your credit file to see if you've got any defaults or bankruptcy in your credit history. They also look at the number of inquiries on your file and require an explanation for each inquiry. It's best not to apply for credit with multiple lenders, especially in the year leading up to applying for a home loan, as this can be a red flag. Lenders will also look at your employment history over the last few years and how long you've been in your current job. So unless you're a contractor or temporary employee, switching jobs all the time makes you look unstable. Lenders will also look at how often you've changed addresses over the last 3 years and whether or not you've been paying your bills on time. Not to worry if you don't have a great credit history, as you might qualify for a non-conforming loan, or you could see a credit repair specialist who might be able to help you repair your credit file. Number 2 is capital. Capital refers to your net worth, and this is calculated by the total amount of your assets minus any liabilities. So for example, the total value of any properties you own, savings accounts, vehicles, shares, superannuation, etc., minus any debts you may have, such as home loans, personal loans, and credit cards. Lenders look at your ability to save and create wealth by accumulating assets. If you're very young, say under 25, it's understandable that you wouldn't have many assets, so your ability to save and pay your bills and rent on time is taken into account. On the other hand, if you're over 55 and have few or no assets and no debts and perhaps only a small amount in savings, you might not qualify for a home loan. A lender will assess your situation and assume that you may not be that good at managing your money, and given that you are closer to retirement age, it'll be hard to show an exit strategy if you have no other assets. Number 3 is capacity. So when we talk about your maximum borrowing capacity, this is the maximum amount that you may be able to borrow based on several factors. Lenders use servicing calculators, which include a debt-to-income ratio based on how much income you receive, say from employment and rental income and any other income you might have, compared to your level of debt and monthly household expenditure. And lenders now require a detailed list of all of your monthly expenses, which includes groceries, entertainment, utilities, and much more. If your expenses are less than the average household expenditure measure, otherwise known as HEM, the lender will use the HEM guidelines rather than your actual expenses. Your new proposed home loan repayments will be included as part of your monthly outgoings and will be calculated at an assessment rate of over 7% rather than the actual rate you will be paying, which is usually under 4% at the moment. This is so that there's a safe enough buffer should interest rates rise. Your credit card repayments will be based on the assumption that you pay 3% of your limit every month, so if you want to increase your borrowing capacity for a home loan, consider decreasing your credit card debt. The other expense to look out for prior to applying for a loan are facilities such as Afterpay and ZipPay. These can affect your borrowing capacity at the time. So if you have any of these facilities open when you're about to apply for a loan, it'd be a good idea to pay them off and close them out. So to sum up how your borrowing capacity is calculated, lenders will look at your monthly incomings minus monthly outgoings to show a surplus or shortfall of funds left over. A debt-to-income ratio of less than 1 indicates that you don't have enough funds left over after all your outgoings are taken into consideration to be able to repay the loan. Number 4 is collateral. Collateral is the property being used to secure the loan. The value of the security property should be more than the loan amount. If you need to borrow more than 80% of the purchase price, you'll have to pay lender's mortgage insurance, otherwise known as LMI, and this covers the lender should you default on your repayments. If you want to avoid paying LMI, you can try to save up at least 20% of the purchase price and around 5% in costs for stamp duty and other fees. Or you could do what is called a family guarantee, whereby, for example, your parents offer to use the equity in their home as additional security for your loan to get the LVR, loan to value ratio, down to 80%. Bear in mind that your family will be putting their home at risk should you not be able to keep up with your repayments, so it's always best to seek legal advice first. Number 5 are the conditions. Now this refers to the financial conditions that exist at the time you submit your application. So that includes your interest rate, principal amount, and general market conditions. Conditions refers to any circumstances that may affect your financial situation and ability to repay your loan. As part of the conditions, the lender will want to know what the purpose of the loan is. So whether it's owner-occupied or investment, and if you're applying for an interest-only loan, the lender will require a good explanation as to why you're choosing to pay interest only. Also, if you're over 55 or sometimes 50 years of age, the lenders typically require you to have an exit strategy. So what this means is that you'll have to demonstrate to the lender how you will continue to make your loan repayments after you retire. So you'll need to show proof of your life insurance, superannuation, and the value of any other assets in which you own. This is to assure the lender that the loan will not end up causing you or your family financial hardship in the future. So hopefully this has helped you to understand a bit more about how lenders assess your application. As mortgage professionals, our aim is to help you build a strong file to present to the lender so that you have the best possible chance of getting approved for a home loan. And if you'd like to chat further with me, no obligation whatsoever, just give us a call on 03 8518 4191 or get in touch via the website baysidefinancesolutions.com.au, or you can join us on Facebook using @Bayside Finance Solutions. We're based in Elwood, Victoria and service all of Melbourne. Thanks for listening today.
The world of finance changes on a daily basis, so to avoid missing out on groundbreaking changes, like our Facebook page to be notified of future podcast episodes, and feel free to share Bayside's tips with your friends and family.